Welcome to Investors Guide. I'm Faye D'Souza. Thank you so much for joining us. Now, in a bid to make you more familiar with the people who run the mutual funds that you invest in, we've started a series of interviews to bring you face to face with the people behind the mutual funds. Our first interview is with Leo Puri, the Managing Director of UTI. Leo, thank you so much for giving us time.
Thank you.
We have a lot of investors across the country who use UTI mutual funds. And they also have a reputation for being the kind of investor that doesn't become fidgety in difficult markets, people who just put their money in and just leave it there. In this market particularly, which is becoming a little difficult to read because of the influence from foreign markets these days, because of what's happening with NPAs domestically, what is your word of advice right now for your investors of UTI Mutual Fund?
I think two things seem to have happened post the 2008 financial crisis, which I think history will view as a defining watershed. One is volatility has been heightened, and that's not a short-term phenomenon. That's something that is now here to stay because imbalances, great imbalances, have been generated by central bank action.
So we're just going to have to get used to more volatility.
I think it is likely to be a continuing trend across asset classes, whether commodities, gold, or of course equities as well. The second thing that has happened, and again we'll see, time will tell, is that you're probably likely to get lower returns from different asset classes than we have been used to over the past several decades.
I know investors are not going to like hearing that.
They may not, but this has been, there's been a very interesting piece of research put out by the McKinsey Global Institute on some of the drivers of this, partly to do with the way corporate earnings are going, partly to do with where inflation is actually headed. But in general, you could have a 1.5% to 2% secular drop. The entire curve, if you like, is going to drop. That has significant implications for pensions, retirement, etc. around the world, of course. So it's not a disaster, but it is something which I think we have to get used to.
So let me then just break it up and take it piece by piece. If we're looking just at equity right now, whether I am directly in the equity market as a retail investor, which is long-term money, or ideally long-term money at least, or if I'm using a mutual fund, what are your expectations from equity, say for the next 4, 5, maybe 10 years?
You know, we have been fortunate in India that equities has in general managed to hold, let's say, a 5% premium over risk-free assets, looked at through the cycle, which is a fairly healthy return. And this has prevailed whether we've had periods of moderate inflation or high inflation. We've not yet had a period of low inflation, which is what the RBI is trying to take us towards. But I assume if that gap may not hold quite that wide when you get, if we actually get to holding 3-4%. But as long as inflation has been, let's say, between 6% upwards, which is where we've been, that delta has held. That's a very healthy return. So a growth market with high quality companies hopefully should sustain the alpha, if you like, over risk-free returns, which is one of the reasons why being invested in Indian equities as an Indian investor, I think will still be a good story, even if across the world the entire curve drops.
The delta that I get over fixed income, which is if I'm getting, say, 8% from my fixed deposit on a government bond, I'm used to getting 5% more than that from equity. You expect that margin to come down to how much?
Well, no, I think I do think that relationship will hold steady, as I said.
We continue to do better, but
you may see some compression of that margin if we move to a lower interest regime. By the way, moving to a lower interest regime will have a bunch of other important benefits for Indian consumers, taxpayers, and so on. So it wouldn't be a bad thing altogether to have that phenomenon. But the good quality companies and the high growth phase that India is in for the next 2 decades, I think will sustain that differential.
I also want to understand from you, you know, the last time we talked, you talked about how you believe we're in a long-term bull run, provided we don't score some own goals. Do you still believe that? We haven't seen corporate numbers improve as much as we would have liked them to see. The market is still holding its breath largely over the monsoon right now, and the global cues are still affecting us drastically. Do you still believe our fundamentals are strong? And do you hold that thought yet that we are in a long-term bull run and we are going to see this play out?
On a fundamental level, there are in fact 2 reasons to feel, if anything, a little more optimistic than a year ago. One is that I think in the next 2 or 3 years, we've seen a clearer commitment from the government towards initiating now a public investment cycle, which I think could be a catalyst for private sector investment, which remains the one missing joker in this pack at this stage. But I think that's positive. I think you will see more sustained commitment towards reforms, a more market-led friendly posture, if you like, on the part of the government as well. And we've seen a relative amount of stability globally for the time being as investors have returned to emerging markets.
Will that do the trick? The government changing its stance at this point over the last 2 years, is that what we needed in India? Is that it?
No, that's merely a catalyst. It's a catalyst because it essentially helps drive the investment side of the balance sheet, if you like. On the consumption side, and that's the other piece of good news I was coming to, we've actually continued to do quite well. Despite 2 bad monsoons, what has kept us going at 7% is consumption. We are a consumption-led. You don't want to be overly dependent on consumption. I know China is trying to shift that way, but India, if anything, has had the reverse problem that we have needed to sustain, I think, a few decades of investment-led growth as well, given how much catching up we have to do in infrastructure and other areas. But I think that balance is important for us. And if indeed you get a decent monsoon, as looks statistically likely, and the meteorologists are already predicting that, you could have demand actually not just sustaining but strengthening, and rural demand in particular coming back, and therefore large categories, whether it's cement and FMCG and so on, benefiting materially from that. So the prediction that has been made for the last 3 years and not been met, of 15% earnings growth, which is ultimately what will sustain the market, has a much higher probability of being met this year. I think.
How much higher?
I think, all analysts start by saying they expect mid-teens corporate earnings growth almost every year. I mean, they may vary it by a couple of percent. And we've fallen, of course, well short in the last 2 years across the index on that. I think the likelihood of the demand-driven industries reviving, as I said, is fairly high. And that's likely to happen in the earlier part of the year. So
UTI being one of the largest domestic investors we have in this market, how are you approaching this market right now? What's your investment philosophy?
Our investment philosophy has always been to search for companies with a strong track record in a sense. But the foundational element is growth at a reasonable price.
Okay.
India, there's always debate, is it a value market, is it a growth market? And and the reality is you need to pick stocks bottom up, which is what players like us try to do. And you keep searching there for growth at a reasonable price based on the research that you do. We cover about 400 stocks or so. So we have a fairly broad universe. And we add new ideas as and when, portfolio managers or others spot companies. And we are still seeing fairly rich bottom-up opportunities of companies that meet the criteria of the growth at reasonable price philosophy.
I know the banking sector and banking funds are making a lot of retail investors nervous at this point. What's UTI's approach to the banking sector? The NPI is making you nervous?
Well, coming into the election rally, actually we were somewhat underweight banking. And in a sense we were defensive, and we did that initial spurt that happened, we missed out. We've, of course, benefited somewhat from the retreat that happened thereafter.
We've seen a lot of funds across the market focus on banking and then get punished for it over the last year or so.
I think given that it's 30% of the market weight, you can't avoid it. You will have to take a posture, and there will occasionally be temptations on the part of fund managers to swing for the fences, if you like. That's not a philosophy UTI has followed. We have been positive on certain private sector banks. We have very selectively looked at PSU banks, but our view is that the jury is still out as to whether some of the initiatives being taken around Indradhanush, some of the initiatives being taken around the asset quality review, and the yet to be seen attempts at raising fresh capital will play out. I think you could take a heroic bet and assume that all of that will come together this year and start loading up on PSU banks. our view is you need to be very cautious, and there will be a couple perhaps that and we keep an eye on those that we think are likely to break away, but we are not betting on a near-term systemic re-rating.
Do you believe it's going to get worse before it gets better for PSU banks?
I think in the very near term, absolutely, it is going to get worse. I think there are some attempts to cheer up and talk up the market.
So your advice to people holding banking funds right now is to continue to hold them?
It depends on the underlying portfolio construction. I think you do have both diversified and retail-oriented institutions. I think we've had retail-oriented banks doing well, but I don't think you should hold only retail-oriented banks. I think the corporate wholesale banking cycle will come back. And there are banks that have successfully participated in the corporate banking sector, but done so through products and risk management, which is HDFC, of course, stands out in that regard. So there's some benefit to having investments in diversified institutions as opposed to retail only, because you do see consumer credit cycles which could impact. So I think going overboard on the retail credit story is a little risky as well.
Well, the other set of funds that are making investors slightly nervous are large cap funds, which are still in negative territory for the year. Again, what is your, and this is the average, the category average of large cap funds is in negative territory. What is your call on these funds right now? What would you say to investors who showed up saying, what's going on? Why are we in negative territory?
So again, I think from a stock picking point of view, the large cap funds do perform well when you look across the cycle. They typically in difficult times, in fact, outperform mid caps. So they do have an element of defensiveness to them. And I don't think that's a bad thing for a retail household investor to actually keep in mind. You don't need to have a portfolio constructed entirely of aggressive positionings, where you bet your life savings on trying to outperform. So I think it is very important to stay committed to large caps, because the quality, stability of earnings and their ability to attract consistent flows over the cycle is unmatched.
I think that's the other risk we're running at this point. If we look at the leaderboard of where these funds stand, mid caps and small caps might seem slightly more attractive.
Yeah.
There's a risk here that an investor might pick a mid cap assuming that it would possibly repeat that performance that we've seen over the last year. What warning would you issue to someone who's hoping for that, a repeat performance of mid caps?
It's never wise for a household to be overly committed. So in terms of fresh incremental savings that come in, I don't think you need to sell your mid cap holdings at this point or panic about them. But it would be, unless you have a very high risk appetite, so continuing to put all your incremental savings into mid cap because past performance has exceeded large caps would be a very risky bet.
If I gave you 100 rupees today and asked you to split it up ideally for an average 35-year-old with the next 25 years of working ahead of them, how would you split it large, mid and small?
I would put half immediately into a large cap diversified fund and maybe a quarter into a mid, a sort of multi-cap if you like. The balance, actually, you could look at a combination of a tax saving, and it's an interesting idea to try one or two of the thematic funds. Thematic, I mean something like an MNC or because these are, of course, they tend to be more cycle dependent,
and they trap you in the corner when that sector is doing that.
But they will again. So therefore, they require a little more management. In that sense, you need a little more market
conviction,
timing.
I suppose.
But the outperformance that they can generate at the time they do well makes it worthwhile.
We talked about fixed income, and you did say, of course, that we should expect over a period of time that the kind of returns that we're used to are possibly going to come down. And I know you mean fixed income because we're expecting that to happen. But I want to focus on the fact that in terms of retirement, we don't have as many options as we would have liked to. The thing that makes me personally nervous is that we're still highly dependent on defined benefit schemes or schemes that mentally assure a certain rate that we might not be able to keep for the next 20 years. it sort of puts a large portion of the working salaried population at risk. What's again your advice to someone who invests in the PF, in the PPF, in the EPFO, and perhaps assumes that their retirement is taken care of?
Yeah, I think the government policy on this appears quite clear. Despite the rollbacks and confusion, the government is trying to shift everybody to a defined contribution scheme. So it's a matter of time before the guaranteed
even the
returns
flip-flop that we've seen over the last couple of months, post-budget, and they've been, there's been reaction on the street. It does seem like those changes were not fairly well thought out, or not all stakeholders were on board.
Perhaps there could have been better alignment and better planning around the communication and introduction of those initiatives, but the initiatives are the right initiatives. I think barring a few people who are truly at the bottom of the pyramid, who should be better served by welfare, I mean something like the Atal Pension Yojana, where you really need a guarantee because they cannot take the risk of market-led, if you like. For everybody else, I think it's right that we shift to defined contribution, and that's what the NPS has introduced. The EPF will also evolve towards being more of a defined contribution
Right, but now NPS
scheme.
is at a tax disadvantage, because we have investors writing to us every day saying, why would the NPS is being taxed, the PF is not being taxed, so
I expect convergence. I expect convergence within 2 or 3 years, and I think that I actually think you will more likely move to an EET regime. I know your listeners may not like to hear this because
I don't like to hear it.
exempt, exempt, exempt. But there are no systems around the world which are, triple E and are sustained that way. So the convergence, now you can soften that to some extent by having partial withdrawals, EEE, and then partially an annuity, which is EET. And I think there needs to be some careful thought given to that.
Perhaps more flexibility. I mean, as a salaried employee myself, when I look at my EPFO, the thing that bothers me about it is somebody else decides how much of my salary goes into the EPFO. Somebody else decides what return it will generate, what the underlying asset is, how long I have to hold it for. And after I've met with all of those rules, at the age of 58, you will tell me that you want to tax it. I mean, I think at least flexibility on the decision making should be allowed if you are going to tax it.
Now, there's 2 elements here of the EPF which people have liked. One is the flexibility to withdraw at any point. That some thought needs to be given as to how you transition, because people have made decisions assuming they have that flexibility. And I agree that it's very hard to unilaterally take it away in one fell swoop.
Especially for something that's that long term.
So you cannot, frankly, do that. So you may have to just rethink this process in terms of how you grandfather certain existing expectations and how you transition new entrants, if you like, to a new set of expectations and converge that over time. But that's the politics and mechanics of how you transition.
In an ideal world then, if we're looking at defined contribution, shouldn't there also be an equity element in the EPF?
There must be, and I think that's been a big
resistance towards that.
That's been a tremendous failing of the EPF, that nobody is accountable for the opportunity loss. So whatever you have gained in terms of the tax-free exemption, you have lost because you failed to get that 5%. I use 5% as an indication. Maybe in some years it's 3, in some years it's 7. But so here's the irony, is that we are so obsessed with taxation in this country, we have not focused on the fact that had we invested on a tax-paying basis in an NPS-like structure with 50% equity, let alone 75, from the age of 25, post-tax, we would have ended up materially better than we did, clinging on to something where we have a tax-free outcome, if you like, but essentially an artificially managed lower rate than we would have
And a lot of people don't realize that whether it's the PPF or the EPFO, that is 8.5 to 8 3/4 is not a guaranteed rate for the next 20 years. It is a rate that will be reset every year, likely reset downwards.
So it's not a guarantee, it's a politically sensitive rate, so people assume that it has a certain amount of political assurance around it. And there's some basis to that because we can see the tussle there that happens. But of course it's not guaranteed, it's unsustainable. And the entire trend, and it's a good trend, of market-linked rates across the economy, starting with small savings schemes, starting with liberalization of savings accounts and bank rates and so on, is to get us to a market-driven regime. No system can sustain itself trying to offer guaranteed rates or managed rates across the economy. It creates huge distortions and ultimately cost borrowers or lenders much more than they need to pay. So it's a very healthy trend. It's going to happen. We should embrace it. And we should not focus on tax as the primary determinant of a good investment decision. That is a universal failing, where I've seen many households base all their investment decisions on essentially this point. We have a cultural aversion to the idea of tax, and it clouds our ability to see good investment opportunities, which on a post-tax basis will far outweigh the returns you will get on these tax shields
but to be
time
fair,
and time again.
To be fair, the average Indian middle-class salaried person will tell you that the tax burden, for some reason, lies only on a small set of people. In terms of increasing, the government is not focusing as much as increasing the tax net, bringing more people into the net, as constantly, burdening the salaried class, which I think is unfair.
Very important agenda, but I think that's what the black money bill and others are attempting to do. That's what all these other things, which also appear to irk many of the middle class, about having to use your PAN card when you spend a certain amount of money now, and the kind of records that are being kept, some of the more invasive practices, if you like, that you will now see, are aimed at broadening the tax. And they should include agriculture. That's my only ground, says we must include agriculture. But
maybe past a certain income, but yes.
Yes, but of course above a certain income. Nobody wants to tax poor farmers, but we have plenty of wealthy people hiding behind a shield broadly defined as agriculture, which is not acceptable to the rest of the citizens.
There's a lot of talk about the fact that UTI is a bit of an AMC orphan, because we are in an industry where parents of AMCs tend to be very strong influencers. You have 5 different parents, and none of them particularly, taking an active stance in the day-to-day running, which might be good for you. What is your plan taking this particular company forward in terms of when you plan to list, in terms of the personality that you're building, given what you took up? And where are you planning on taking it? Because from culture, it's a very different company.
Yeah, we have always been an independent company. We are not the child or grandchild of any other entity. Even our sponsors, if you like, are not really entities who promoted UTI. It was promoted.
Some of them have children of their own.
Yeah, exactly. They have competing funds, and it has been a clear view laid out by our board that we wish to be an independent, listed asset manager. We think we will be a listed entity. The only thing that's stopping us is that one of our shareholders would like to essentially, as an alternative proposal, most of our shareholders actually are supporting the idea of a listing. We think the government will support. Proposal? It's been publicly stated that's the State Bank of India, which has a right, I guess, to express its views on the topic. But we don't think that's not acceptable to the board of UTI. And we don't think it's acceptable to the other shareholders. We also don't think it fits in with the government's intention to actually create strong capital markets with independent institutions, or to indeed manage reform in a way that is market-led and would lead to the creation of market-led institutions.
UTI has also had one of the most sustained investor education initiatives, that we've been part of as well. I understand the regulations have changed a little bit this year, that you're going to be doing it a little more differently. But I want to know what you're doing to sort of tap into even further into the country, to go even deeper into maybe tier 2, tier 3, smaller towns, reach people who are, only now waking up to the idea of investing in anything other than maybe a bank deposit.
Yeah, so Swatantra has been a very successful initiative, but we wanted to take it into regional languages, which is what we've done. And I think we'll continue to find new media to do that. We've tried radio recently, which has worked quite well. We need the right products. We need to be very careful that we sell products that have the right balance between risk and reward, suitably designed, low cost, easily understood. So simplification there is vital. That's our responsibility as a manufacturer. So we think those schemes are going to be what will lead us into this next phase of penetration or inclusion, and we're quite excited about that.
I wish you very, very good luck, Leo. Thank you for speaking with us.
Thank you. Thank you very much.